Welcome back to Strongman Personal Finance. We got a sponsor video today. That's right. In the middle of tax season, I was clown enough to accept a sponsored video. And if you want a sponsored video, see the pinned comment below. Send me $50 and I'll talk about whatever you want. I don't do stock price predictions and I don't do valuations. But more importantly, if you want me to do your 2024 taxes, and you do, trust me, see the pinned comment at the conclusion of this video. I do business and personal taxes, any state in the United States. I give you a free consultation, an upfront quote, and then I prepare your taxes. Military discounts apply. NASA surcharges also apply. So in this sponsored video, we're going to go over Bill Stock Bro. Now, I've heard of Bill before, okay? Let's make sure we're sharing. I'm always paranoid I'm not sharing. Bill Holdings Incorporated. So if you're a business and you want to manage your accounts payable, accounts receivable, expense reports, you probably need some kind of software. Okay? Hey, I'm a girl. And Bill is one of the 100,000 companies that offers this kind of stuff. Because, you know, in a business, you got a lot of stuff going on. You got, some people owe you money. People, you know, you owe people money and you got to track it. That's where Bill comes in, okay? Now, I can tell you right off the bat, there's 100,000 different competitors. If I had, like, a business where I had receivables, which I don't because I always get paid up front, then I would consider using QuickBooks or something. I'd probably use QuickBooks. But Bill is an alternative. So we're going to go ahead and check out this company, and we're going to see what it's all about. So let's see how the stunk has done over the past year. Oh! Only down 39% year to date. Woo! Now, my favorite investment analysis tool is to look at the 5-year chart. And based on the 5-year chart, this stock is garbage, okay? Anyway, it's got a market cap of $5.26 billion with a massive decline in the stock that usually indicates future expectations of the company's profits are not good. On revenue of $1.39 billion. And net income of $81 million. $81 million of profit on $1.39 billion of revenue. A PE ratio of 132 and a forward PE of 28. I wonder if they had some kind of impairment charge or write-down. We got a price target of analysts of 81 from the current 51 with 58% upside. Oh! So let's see what this accounts payable, accounts receivable company has done. Okay, so revenue was growing pretty steadily. Okay, it was just teeny tiny little revenue back in 2020. And then it had a massive spurt of growth, it looks like, in 2022. But you can clearly see the trend starting to flatline a little bit. You see that, ladies and gentlemen? Revenue growth was massive, but it's also decelerating massively. I mean, this is a huge market. How many companies offer freaking AP, AR management? I mean, I work for a corporation. We use different software than this for accounts payable, expense reimbursements. There's 100,000 options out there for this kind of stuff. Anyway, the revenue is still growing and it has decent growth year over year, but you can tell it's decelerating. Let's look at the profits. Profits, bro. Let's look at EPS growth over time. So this company has been unprofitable on a GAAP basis for basically its entire history until 2 quarters ago where, okay, they had 2 quarters of GAAP positive earnings per share. GAAP matches expenses to revenues, okay? And it doesn't mean cash. Cash and GAAP are 2 different things. Cash is cash you get. You can record revenue and expenses without receiving or paying cash. It's all about the underlying substance, okay? I'm a genius, but I'm a course. So EPS has been mostly negative, and they had 2 quarters of positive EPS, it looks like. And then their most recent quarter, they had negative earnings per share. I wonder if it's stock-based compensation. Free cash flow per share has actually grown pretty impressively. I'm going to guess this company has a lot of stock-based compensation, okay? Pretty steady, strong gross margins, negative operating margins, and then occasional profit margins. I mean, we'll see why. So, like every other tech company, very strong free cash flow margins and very weak operating margins because they're probably issuing stock, and stock costs you money as a shareholder. It dilutes you, and the company has to spend cash buying back the shares. And a lot of the times, those buybacks consume a lot of the free cash flow just to keep the share count equal. There's other companies that don't have crazy dilution, and they actually reduce the float, or they pay you a dividend. But companies that dilute a lot, they got to spend a ton of money buying back stock. Just saying, okay? Doesn't matter, bro. U.S. stocks, bro. What's a U.S. stock, bro? All right, we'll look at the balance sheet on their most recent earnings. Let's look at operating cash flow. So pretty significant growth in operating cash flow. Let's see. They're not really doing any capital expenditures. They've barely done no capital expenditures in the last year and a half. Selling intangible assets, not sure what that is. Okay, really nothing crazy on the investment side. They had a pretty significant long-term debt issuance in the third quarter of 2021. Not sure what they did with that. And they've been paying off some debt. That's good. But also packing on debt. They've also done share repurchases. So, okay. In the last quarter, they spent $203 million buying back shares. Let's see how much the float changed. Okay, so the float dropped by 1.35%. And they spent, so you just got a tiny increase in your ownership, assuming you had owned the shares. But they spent $200 million doing that. And then if you look at the prior quarter, their share count still went up by 0.47%, but they spent $201 million on repurchasing of stock. So basically, they made the float go down very slightly, and it cost them $404 million. What was their free cash flow? Wow. So it looks like they spent more than their free cash flow, way more, because their free cash flow in the most recent quarter was $78 million, and then before that it was $88 million. But they spent a total of $404 million buying back stock to just slightly reduce the float. So just to reduce shares outstanding, they had to spend a ton of money, more than their free cash flow. Stock-based compensation, bro. Let's go back and look at their share count over time. Doesn't matter, bro. Yep. Okay. Slight decrease in shares outstanding. Let's go back in their cash flow statement. Yep. Stock-based compensation. There you go. Yep. All right. So let's look at their most recent report. Bill reports second quarter fiscal year 2025 financial results. So, they had 16% or 14% total revenue growth year over year. And then what are they guiding for? Let's see. And then they're guiding for between 13 to 15% year over year growth. Oh, sorry, 9.9 to 11% year over year total revenue growth. Their revenue growth is decelerating pretty significantly. Wow. Okay. And then for the full fiscal year, they're guiding between 13 and 14% revenue growth. But if you go back and look at the years before, much greater growth. So this company's massively decelerating. Wow. All right. Let's see. About Bill. We offer accounts payable and accounts receivable and expense management. How unique and rare. All right, let's read the free cash flow. Yeah, nothing important. All right, let's look at their balance sheet. So they got $1.5 billion of cash and $644 million of short-term investments and $28 million of receivables. Let's see. Acquired credit card receivables. Interesting. Let's see. So total highly liquid assets are, $2.2 billion. And then their short-term debts after customer fund deposits are 400 billion. So from a liquidity standpoint, I think they're fine. They got a lot of cash. A lot of cash. Let's look at long-term assets. Woo! Look at that goodwill, baby. 2.3 billion of goodwill. So out of all of their assets, we got 253 plus 2396 divided by 9674. 27% of their assets are completely intangible, and the vast majority of that is goodwill, which is just buying another business for more than the fair value of its net assets. It's a plug entry. It's an intangible asset. That means they paid more than a business's assets minus liabilities were worth at fair value, which isn't always a bad thing, but if you made a bad investment, it could clap your cheeks. All right, so let's see. They got almost $4 billion of funds held for customers. Wow. Okay, let's look at their... Okay, they have some convertible senior notes that are coming due within a year, 33 million. Woo, look at that debt, baby. What did they buy with that debt? Okay, I see no change in long-term assets. I wonder if they issued convertible senior notes to buy back shares? I mean, they issued over 700 million of convertible senior notes in the last 6 months. In 6 months, they raised $700 million of convertible senior notes. And it looks like they used it to, well, obviously they didn't spend it all because they're cash. So they spent, let's say how much did they spend it? How much did they raise exactly? So convertible senior notes went up by 765 million. So they added 765 million of debt. And then their cash balance has increased by 581 million. So they spent about 200. Okay, so they raised debt, and it looks like most of that money went to buying back shares to barely decrease the float. And then the notes are convertible to stock. Like, at least that's what I think it is. Like, I don't understand what they're doing. Why are they packing on this much debt? Maybe they'll explain it in a little bit. Okay. Good Lord. Okay, so that's funny. So they have interest on funds held by customers. So I guess they hold custody of customer funds, and then they collect the interest on it. What a bunch of grifters. So obviously the vast majority is subscription revenue, but they also earn a significant chunk of their revenue from interest on customer funds. Actually, the percentage of that, so roughly 11% of their revenue comes from interest they earned on customer funds. And if rates come down, that's probably going to drop pretty significantly. Just saying. Okay. But they are showing pretty, decent subscription and transaction fees revenue growth. Let's see. What are their biggest expenses? Sales and marketing. Pretty significant increase from 118 million to 132 million for the 3 months into December 1st, 2024. Could be mostly stock-based compensation. They had an operating loss. Other income. What is the other income? Okay, so they're posting operating losses, but they have other income, which they're not saying what it is. And that's the only reason they even have positive earnings per share. But their core business is unprofitable because of stock-based compensation. Wow. Oh, but they're buying back stock with debt, with convertible debt. I mean, maybe I'm reading this wrong. Let's see. This is their statement of cash flows. Okay, gain on extinguishment of debt. Interesting. But they still packed on more debt. I'm just looking. Why did they pack on all this debt? What are they doing with it? Somebody tell me. All right, let's see if we can find out what the debt's for. They don't freaking say. Well, it looks like they just took on a bunch of debt and used it to maybe pay off other debt and then buy back stock. I mean, that's where most of their financing cash flow went. They borrowed 1.4 billion, then they paid off 539 million of debt, and then they also repurchased 200 million of stock. Okay, like I don't know what's going on here. It's a very weird business. It's in a highly competitive industry. Revenue growth is massively decelerating. They're guiding for lower revenue. Heavy stock-based compensation. They're spending more than their free cash flow to barely decrease the float. They're not profitable from an operating standpoint. And I don't know what the other income is. Other income net. No description of what that is. But from an operating standpoint, they're unprofitable. Then they have this other. I don't know if it's. I don't know. It doesn't say what it is. Maybe it's the freaking bond extinguishment, the gain on extinguishment of the bonds, which that's not a recurring profit for them. So honestly, I don't like this company. Let's look at the valuations. It's another stupid tech stock. Texas Tech, bro. Oh, but the 4P's lower, bro. Price to sales is down, bro. Price to books is down. I mean, when it comes to like, oh, it's cheap. 17 price to free cash flow. 16 price to operating cash flow. But this company is going to dilute you to kingdom come. And just to keep the float flat, they're going to have to expend more than they're making in free cash flow. So once again, they're enriching the freaking shareholders, the employees. What a disaster. All right, let's do some comments. Wow. Can you do Canadian taxes? No. The clown stock is strong in this company. It's another tech stock. It's always the same thing. You can just, as soon as I see it, I'm like, they have a lot of free cash flow, but they don't have a lot of, they don't have any profit. I wonder what it could be. Can you look at Tattooed Chef? I wish they would go public again. Easy there, strong man, vertical. It will vertical line tomorrow, and then everybody will make fun of me. The underperformance of this is absolutely shocking. I mean, this is an extremely competitive industry. And I personally rather use QuickBooks. Just saying. Jeremy's watching. I'm sure he is. That's a fake Jeremy. Is it true Jeremy huffs dirty diapers for spiritual reasons? Dude, he's one of those, like, spiritual weirdos. You know, he believes in, like, special numbers and stuff. Jeremy's a special guy. But I got a good exposure of him coming out. I actually found that he had to sell, or he almost sold his house in 2022 because he was suffering that bad from the clown market. We were this close to destroying him. We'll get to it. Did you wear a diaper? Yeah, every day. Let's see. I knew I should have invested. Yeah, that's right. VT's in the lead this year, bussies. You guys like that? You mad? Huh? VT's crushing your indexes, your U.S. stocks, bro. Yeah. What are you going to do about it, huh? Nothing, bussy. Rip. Oh, they'll vertical line any day now. Comment about goodwill. Things not tangible like can be very valuable and must be in goodwill. No, it doesn't necessarily mean it's bad. Okay, all goodwill means is you purchased a business for more than the fair value of its net assets. That's all it means. Could be good, could be bad. All depends on whether you bought a good business. I mean, every business that's profitable and is growing profits, yeah, it's going to be worth more than the fair value of its net assets because it's going to have future profits. So it's not necessarily a bad thing. It's like if you bought McDonald's, McDonald's is worth more than all of its real estate minus all its debts. Duh. Okay? That's goodwill. But when you account for it, you have to record goodwill. Oh, come over. I'll help you out. I'll rub some on you. Jeremy sell is Wally World stock. What? Do a video on covered call ETFs, which are all the rage again. They're not going to be if the market plunges. Do I get a military discount for your tax service? Yes, you get a military discount, even if you served with Khmer. But Khmer does not get a military discount because I don't like him. Oh, congratulations. I was never in Celsius, dude. It was a joke. It was a joke. God. I mean, how clownish do I have to be to to tell you people it's a joke? Time to buy Fubo any day now. Is VTI still the move? Yes, it is. At global market cap weights. Anyway, like, subscribe. Give me $50 if you want a sponsored video. I was paid to make this video. It's $50. See the pinned comment? Pay me money. But better yet, pay me money to do your taxes. Book a free consultation. I'll talk to you for free. I'll quote you up front. You can say yes or no. And then I'll do your taxes. But no, you can go to H&R Block. Yeah, go to Liberty Tax. I'm sure they understand everything there is to know about taxes. Okay, they're the pros. They're the professionals. I'm going to age slowly, but the entertainment will never stop. Okay. How much on average for tax prep? Well, look, I can't just put an average quote out there. Okay. Now, if you have a corporation, probably 1,000 minimum. Unless you have a super easy, I had a super easy partnership that I didn't charge that much for. But on average, corporation, 1,000 minimum. Your average return, if you have one W-2, I'll do it for 200. If you have a W-2 and some stock transactions, you're looking at $350. If you have a Schedule C stock transactions and W-2s, you're looking at $500, $550. And then if you got real estate on top of that, that goes to $600, $650, and up and up and up and up. Okay? It really depends on how complicated your taxes are. But you can talk, I'll give you a quote. And then you say yes or no. Why file any? Go ahead and don't file your taxes. See what happens to you. Okay, anyway, that's it. Like, subscribe, book a free consultation for tax prep, and give me money for a sponsored video. Have a wonderful night. Cheers.